The Central Bank's Monetary Policy Committee's decision to maintain the benchmark lending rate at 9.5% comes as inflation levels marginally increased from 3.67% in January to 4.45% in February. With the benchmark lending rate remaining unchanged, commercial banks are unlikely to review their lending rates downwards, especially considering that they are yet to realign their rates with the central bank's last rate cut, which has resulted in interest rates still hovering above 18%.
So some loan books grow very much, but at the end of the day, it came down to the spreads that the banks earn.
The cost of loans to consumers remains unaffordably high, stunting economic productivity as the cost of finance remains too high. With the central bank's benchmark lending rate at 9.50%, banks are paying an average of 8% in interest to depositors, making a huge disparity between earnings for depositors and the cost of loans. With economic growth for this year projected at 5% by the World Bank, the opportunity to spur a hive of economic activity lies with the availability of finance, especially to small and medium-sized businesses.
And as interest rates come down, then it means that the appetite for borrowing is going to increase. And as the appetite for borrowing increases, then it means that investment increases. And this is very good for the economy because then it drives the economy.
Banks are still, however, basking in the supernormal profits that 2012 produced, creating concern that the financial sector could be growing at the expense of consumers. Michelle Morgan reporting for Citizen Business.